right, so we're going to do a reflection on 2024. We're going to talk about portfolio and team building for 2025. Pretty amazing that this is like, we got 1 month left. It's kind of crazy where it all went. And then we're going to do some examples. And then as always, plenty of time for Q&A.
Well, thank you. So so this is our second session as a preparation for 2025. Last session, we talked about some of those contexts or the forward-looking market data. And so that's to create your investment hypothesis. This webinar, we'll talk about building a team, especially when you go start looking at different teams, what should you go after so that you can understand, right? So especially from the LP perspective. So I'll go back and cover a couple of slides from last week just to kind of set the context up for this week. So 2025, this is the forecast, the CRE forecast from Deloitte. And what they're forecasting is that 2025 will have around 1.1% GDP growth. So just understand a little bit more, which is to be on the surplus, on the GDP surplus or the trade surplus, we need 3% growth for the US. And right now we're at 1.1. Now I have seen some of the other reports from Goldman Sachs. They're forecasting 2.5. So the truth is something between 1.1 to 2, something in that range, right? We tend to believe we'll be closer to the 1%, not full, 2.5%. What we say that because with the GDP growth, there's still a growth. It's a moderate growth. That means we're expecting whatever the correction that's meant to be, it's going to happen soon, sometime, with the next 2 or 3 quarters or so. But also we have seen the rate cuts from the massive side this year. We forecasted, we took a position of 2 cuts. And then this year, I think we're going to end up getting about 3 cuts now. So also what it means is that the bottom for the commercial real estate, it's already here. And now we have to go through another year or so to be on the upside of the whole thing. So looking back, and what we say, when market is tough, that's where you go make the investments, because whatever problem the bubble created, that has bursted. So we have a clean slate moving forward to get to the next upcycle. So going back, our hypothesis is it's a time we all should invest, but at the same time, we must tread very carefully, knowing that, hey, we're at the bottom, everything is left right now is going upwards as we go. And as a context of the rate cuts, I shared this slide that if you look at all the other central banks across the global, everybody started to cut. So the Sweden, UK, and US, we started cutting it now. And as the rate cut happens, you'll see, that's the wave started to happen. So going back to the point number 3, the central banks appear to be on the in a mode of loosening the monetary policy. The tightening already happened. Whatever meant to say, whatever meant to be there, the peak has reached. Right now, we're going to loosen it up. Now the question is, do we do a old jigsaw, which is we loosen it and we kind of let it loose a little bit, then tighten it up, then go back out again? That I don't think so. Feds are pushing it. That's what happened in the 80s and 90s, where it was up and down, up and down. We're trying to hold it steady. So what we are thinking is that 1 more cut this year, and then next year, Q1 and Q2, we'll have maybe 1 or 2, but very slow cuts as we go. And by the time we get to next year, this time, there will be 1 whole percentage point reduction based on where we're at. And that's the forecast. And we're seeing all the central banks to get eased on it. And also we're seeing that getting that little comfort zones kicking in slowly on the real estate side. This one is the optimism. Look at the number 3. It was 880 global CEOs have did the survey for Deloitte. And if you look at the 2025 right here, almost 88% of thinking they're going to increase the revenue. What it means is that everything drives on revenue on the market side. So the sentiment is real, where everybody's thinking that all the revenue will stay steady, even though the company growth will happen based on AI and other impacts that we have on the tech side. Job reduction may happen a little bit, and that's going to get calibrated out within a year or so. So even though some of the sectors you're seeing a pressure, such as tech sector now, but the revenue of those companies are going up. So all in all, and that slow or the soft landing, it's here. We're going to go through a little bit, then we're going to come back out. That's our position getting into 25. Boiling down to the real estate, if you look at the North Americas, what's the most sector that is set up to have the most upside, because those are the sector took the most amount of downside so far. It's one is the multifamily was number 3 on the globe side, but for US it's number 1. Then you have the logistical assets and or the warehousing, and then you have industrial manufacturing, then you have the retail as a steady state. So from the business model perspective, from massive side, we are doing the similar methodology. We are underwriting heavily on the multifamily, but we are making sure that we are doing diligent homework to make sure that whatever that we acquire, it makes sense. So even though our biggest volume of the deal flow is multifamily, it has been, but not that many deals is penciling out. When you look at the business park and logistics, one of the beautiful thing about the logistics is there's an organic barrier to entry uh, because of the debt terms that you get. Based on that, we're seeing the business park and logistics are working out, especially on the new construction side. And the industrial park, it's similar thing working out, especially on the new construction side. And also the neighborhood retail is working out because those are value-based pricing, not cost plus. If you do multifamily, sometimes it's a cost plus, which is somebody's salary is X, so X divided by some equation, and Y is your monthly that you max pay, right? Versus the value based is I got 2 kids, I'm a working couple, and we live in a house. My daughter wants ice cream next door. I know that thing is more expensive, but I don't want to drive 10 minutes. I'd rather pay $1 extra, go get the ice cream. That's a value based pricing. So most of our retail neighborhood, based on that perspective, industrials and business park and new construction, we like that because everything is most expensive when you do the deal. Loans are expensive, materials are expensive, which is at par with the market. So we like it because we are making the business model possible with the most amount of burden. So if things gets better, everything is on our side, right? And that's where you want to be. You don't want to ride. You want to ride the tide. You don't want to go against the tide. And ideally, you want to see where the tide is going and kind of position an investment according to that location, right? All right, so going back, so this week's topic is underwriting the sponsor team. I was joking around with Trevor. It's like as I was typing out, I was like, okay, I will write down everything, then I will run through massive capital team and see where we shake out to be. So most of you guys are LP, which is the limited partners, which is passive investors. This one's the call is geared towards the passive investors. Our goal is to give you guys enough flavor to understand what to look for, what not to look for, or if you need to reach out to someone who's actively doing deals, you join our call and ask us anything that you may have, right? So look at from that perspective, is if we're LP and we're going to invest, and I'm coming in brand new, how do I build a team for 2025? By the way, that's Ellen. Ellen is our chief underwriting person. So if you don't do a deal, that's Ellen's fault. That's my tagline. She doesn't like it every time I say it. It's again, her job is to kill the deal and until the deal is it's a no go. And if she passes the deal, at least the first shot, then Sanjay will come in. He'll do the secondary review, and before we do acquisition, all of us we have to sign off, making sure that deal pencils out from all the partner perspective. All right, so investing in commercial real estate. I broadened that up beyond the multifamily. And what is it? How do you build your team? Now, let's say we're a brand new investor. First time when we come in, the first thing we need to do, we need to understand our business plan. That why am I in real estate? What do I expect out of the real estate? Or if I don't know what my business plan looks like for this year or next year, like have at least a hypothesis. 9 out of 10 times it's gonna change unless you've been doing it for a long time and you're optimizing. But most of the time we see it kind of changes as you go. But have an understanding of what is it that you're looking for out of investment. Why I say that? Depending on the life cycle, depending on my historical background, I may choose different thing. There are typically 3 things that we solve for, or as an investment, most of the real estate will solve for probably 3 things. One, it's the total return. Second is the velocity of the return. Other one is the tax adjusted cash flow or the tax optimized return. And you try to look at that from those 3 angles, and you kind of go, what does that mean? Somebody who's a high earner, okay, so look, I'm looking for tax optimized return. I'm really looking for the total return with some tax touch. I'm not looking for high velocity because I already have a job, I already have a business, I'm working out fine. Versus on the other side, someone could say, you know what, I like it, but I want to do the multiplying. I don't need the cash flow, I don't need the tax optimization, but I need the multiplication, the how quickly I can roll my money. Then you go after that high velocity, which to get a higher multiple of return, and you can get the money faster, redeploy it again. So total return, high velocity, that's what you solve. But sometimes you could be, you know what, I like what I do, but I don't want to get into too much. But I like a steady state cash flow, somewhat of a return. So I go into the total return and the tax optimization, something like that. So again, nothing is right, nothing is wrong. And then also it also matters where is money coming from. The IRA money is different than your cash versus the business exit versus your trust. So put all together, at least have a business plan and know that it's going to change, but at least have one, right? That is, it's very crucial. And if you don't know how to have it, that will make it easy for you. Pull up your last 2 years of tax return, call your.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
CPA, and you say, hey, this is my income looks like last 2 years, and this is my income will be 2024. How do I plan for 2025? Let the CPA do the work as we spend some time last month on it, right? If you don't know, that's fine. Call your CPA, but if you do know, write it down. Once you have your business plan, understand the potential partner's business plan. Identify the overlap. I'll give an example, right? If I am looking for tax optimized play and all the people I hang out with, they do new construction, it doesn't work. We're in 2 different domains, right? I'm an electrical engineer. I want to get an electrical engineering job, but I'm hanging out with a bunch of Meckies, right? I may not get an electrical engineering job, right? So something like that. Understand your potential partner, in this case, syndicating partners or your general partners that you want to invest with. Understand the business plan and identify the overlap. So you want to be as much of an overlap as you can. On that note, have breadth when you come at it. So I always look at it. Yes, I can go to the specialty shop to buy one particular item. But if I go to a good store, then I may have multiple options, right? So you want to have overlaps as wide as you can, and you make sure that you have enough breathing room so you don't have to go partner by partner by partner, right? It's like doing a grocery, right? And if I go one store for apples, then one store for bananas, it doesn't work out. But if you go one store that has all the different fruits, it's easier for you to go. So go back and understand the potential partner business plan and identify the overlap, so you'll see how much time you need to spend with the partners. All right. So after that, let's say you found some partners that make sense. You like to spend some time with them. You understand all this other stuff. Then when you go in, keep on asking the questions. What is the leverage for the GP team, or what their competitive edge, right? Our tagline is, or the way we run Master Capital, we say, look, association will get you started, but differentiation will keep you going, right? Every GP team must have some leverage. Yes, first time if someone is new, I get it. Their leverage is your relationship, but once you come into the play, you must have some leverage. It's leverage with the money, leverage with the knowledge, leverage the relationship, leverage the banking relationship, but you got to have something working for you, even though the whole world is against you, right? Remember, we are investing in a large market, and this is the big markets, especially sponsor team perspective, right? It's fun, but it's a competitive as well. If I don't have an edge, then we'll end up competing on one thing, which is the price. And if I compete only on price, it is a very tough play to have when things go south. So all in all, you need to have breathing room. Sometime, right? You will compete on a price because you know something special about that asset others don't, right? Or you'll go compete on the price, and that's perfectly fine because your cost of doing the construction is much cheaper than somebody else, right? So that's why you gotta have some leverage. I'll give you an example. Sanjay talks about it. He bought an asset in the FW area, 75, 78 units, and he wanted to sell it. And the price he was asking was pretty high, right? But he got the price. And he got the price, and in his mind, he could not figure it out why that person could pay that much, because he was getting about $900 rent, and market rent was 1,000. Spread wasn't this much for him to be true. It needs to be around $1,100, and he just didn't know how to fix it. And that was all bills paid. He just didn't know. Then he was like, I went in and started, walk the asset with the potential buyer, and I asked the buyer up front, hey, I know you're paying this much, but what is your business plan, right? I mean, how are you gonna turn this whole unit out? He goes, I'm a master plumber, and I'm going to redo the whole plumbing system for the building, and I'm going to go from all bills paid to no bills paid. You pay your own individual meters, and my cost is 30-40% cheaper than your cost. So your capex project is 1.5 million, 1 million probably, but my capex is 2/3 of that. So I'll be in the money because I have a leverage, which is I own the construction company or the plumbing company, so I can come ahead of you, and that's the edge you should have, whatever way you take a look at it. So as your LP, keep on asking, what angle is the GP team playing? How they're gonna get something special out of the whole project versus someone else, or what is that they're seeing that others haven't seen for the price that we're paying, right? So that's there. Also, to understand the historical performance and success rate. Now, I want to talk a little bit more about the historical performance and success rate, right? What I meant to say that historical performance could be, different domain. What I meant to say is, if someone is a high performing employee and they have had a good track record of being a really high performer, they will end up being a high performer wherever they go to. So that's the typical trend. Or someone is not a high performing employee. All of a sudden they come from the corporate job by thinking we're going to come back and be a CEO of a 10, 20, 30, $40 million assets. Then they got to ask the question, what is the historical performance, right? That's one way of allowing space for a lot of the new folks that we came in from the corporate side to the real estate, right? Now you could ask the question, if someone in the real estate, what is their historical performance? And that's an interesting question, right? Depending on the asset size, you got to have a meaningful question, right? If someone just flipped 2 houses, right? I'm just going to example 2 or 3, 4 houses, right? Let's say 5. It's a lot of house flipping. But going from a 5 houses, it's a very strong, confident booster. You'd get you the play of it, but it does not mean that you can go to 150 units running asset instantaneously. You have the raw materials, you're going to need the time. So understanding where the historical performance, what the definition of performance is, it's really important, right? And then you have to think about, where did they perform? Did they perform in the industry, outside the real estate, and they come into real estate, or should they perform in the real estate? And what is it what domain that they perform, and what's your definition of performance? And then you can kind of go, right? And the success rate. Now, all of us, we bought stocks, and I think I'm comfortable to say almost all of us, I don't know all of you guys, but almost all of us, we had a whole bunch of winnings, and we have some losses as well. But the success rate, the overall success rate, be on the much of the positive side, right? So the way I take a look at it, if I say, somebody says, hey, I'm going to buy a $10 million asset, $20 million asset, or $30 million assets, right? Or still a 5, and I want to do it coming out the gate. My thing is, show me some performance, right? If you come from the corporate, at least let's talk through and how you have evolved within the corporate world, right? And if you came from school, then okay, let's talk about how you have done in school, right? If you came from other real estate, let's talk about how many houses, how many lands, how many industrial, and how you have built it. Right? So my joke was, on the massive side, our joke was, if whenever we're looking for partners, that if you don't have 35 houses, we're not partners yet. that was our tagline. So that means if someone owns and built a portfolio of 35 single family within the real estate and they manage that, that's a lot. And that's a lot. That means 35 discrete transactions to have that portfolio. That means you have had at least 300, 400 numbers to go around. You have had banking relationship. You've been through enough of a bullets, enough of a rent collections, and 2x4 walking away. So you're comfortable to run more assets, right? That's one of the ways. Always understand the historical performance and the success rate. And I also say, allow people the breathing room, especially when the new folks come about. But we all were new at some point, and we got grounded. Then we came up and running, and so just be objective about the performance and the success rate. Okay, this one, it's a near and dear to us, that the back office breakout. What we call it, if someone has more than $15-20 million asset, they must have employees. They just must, and you'll see it. Most of the failures that happened in the last 2 years, one of the things it showed up over and over and again is that that 1 or 2 person show. They bought $1 billion asset. They got a couple of VAs. It doesn't work. It just doesn't work, right? If someone says I have X million, automatically you should ask a question. Okay, what happens when you get sick? What happens if you do that? Right? It is extremely important for growing companies to have employees that you cannot go. That also puts a testament around how financially solvent the team is, and then you kind of go, right? Because what happens when you run larger assets, 5, 10, $20 million assets? If you think about it, if you're running 5, 10, 20, $30 million companies, right? I know you have ups and downs on the revenue, but when the down happens, if the team is not strong enough, then they will call the LPs for every little things, right? You don't want that. You want the GPs to absorb some of the shocks and bounce and bumps that happens as you go. So for us is that if you are looking for a partner who has more than $15-20 million worth of assets and they're running it, and the back office is very critical, and as you go, and that's like extremely critical. And you ask the back office, if they have 50, 60, 70, they must have people in-house in the US, asset managers running it. And that is especially true when an asset manager who has a full-time job somewhere and you're trying to run an asset in multifamily. Multifamily is great. You can run it, but it's a heavy operations, right? So if you commit 40, 50 hours somewhere else, and then we come out here and we are committing another 30, 40, 50 hours in the nights and weekends, then it's not going to really work, because asset running happens in daytime where we have committed somewhere else. So understanding the GP team's back office is extremely crucial as you kind of go through, especially the larger ones. Now, if you have someone running one asset and they already have some flexibility, fine. It's absolutely fine. But once you buy the 2, the second, and the third, and the fourth, that becomes really, so when you look at it, our thought is look at it very, very critically, and then look at what happens when they get sick. Well, they have to be out of the game for a while. Life happens. What happens then? That's a very critical path, and that's one of the things that we have done from the massive side. Is that early on we knew, we had our business plan was to grow the company, so we brought in team heavy. Like as some of you guys followed us from the very beginning, it was team first, team first, team first. So we are tool first, team second, and then us, and that's how we went about it. And also see them in action. If somebody plays, they will play. It's all the time. If somebody wants to do it, they will do it at all time, and you'll see them playing, good, bad, or ugly. They're gonna come out and play. And is our tagline is, if you don't know how to play during the tough times, you don't know how to play on the good times. The good times, everybody plays well, right? You can't differentiate. So see them in action. Life happens. Some projects are great. Some projects are okay. Some projects are going sideways. But if we don't feel comfortable by talking about what's happening and looking ahead at the problem, then and how would you run a big asset, right? Ultimately, as a LP perspective, you are investing in a large organization. If you think about it, larger assets, and your C-level team got to be strong enough to come out and say. So for me, we said to see them in action, right? Go, shake hands, wherever possible, ask the tough questions, and you kind of go. So the way we say it, right? Just like the kids, I got 2 kids, and if I say something and if they get defensive right away and they be quiet, something is cooking, right? So allow them to be defensive. At the same time, they have to come through and explain what it is that's happening that way. So our recommendation is see them in action, find them, and follow them wherever they go, and we can go from there. So so that was there, right? So now if I spin the whole thing around, right, and say, since we are hosting this webinar, we're gonna ask the question, how does where do we fit in? If I take the framework and we go for the massive capital, where do we fit in? And I'll volunteer to be the guinea pig of it, right? So whenever we run it, this is how we take a look at it. That our biggest thing was deal flow is tough. And why it is tough? Because I have a deal versus I have a deal that is worth underwriting versus I have a deal that's worth buying. It's like that. It's a numbers game, right? And when there is a deal worth buying, two things has to happen. Number one, we should be able to pull the trigger and cut a check to put the earnest money down. And number two, we have to believe that the assumption that we made in those are the right assumptions, right? So here, I'll give an example: California versus Texas. Things are lower cost in Texas, not cheaper. Things are lower cost in Texas for a reason versus California. But when you think that Texas is not lower cost, when you think Texas is cheaper than California, you are in a world of pain because it's cheaper for a reason, right? So it's always, look at it. So from our side, we said, deal velocity must not be a problem. So the first thing that we went after the first year, it's the deal velocity, right? But that came with a process.